Welcome to App Talk with Upptic, where we dig into the nitty-gritty of how to grow apps and games. We speak with industry experts about specific strategies, tools, and tactics they use to find success, and we keep you up to date with emerging news and trends in the ever-changing games, marketing, and technology ecosystem. My name is Xander, Director of Marketing here at Upptic, and joining me today is my co-host,
Warren Woodward, co-founder of Upptic.
And that's it. So we promised this a few weeks ago. We wanted to do another deep dive into some of the state of big game companies' earnings. There's also quite a bit of news around FTX explosion and how that's proliferating through the crypto ecosystem. So we're going to talk about that a little bit, a little more of an informal episode, but hopefully there'll be some interesting stuff for anyone who wants to listen.
Yeah, it feels like it's just been a news whirlwind these last few weeks. It's been exhausting, candidly, Xander. I mean, how are you holding up?
Yeah, I mean, spend too much time on Twitter, so that's probably not super healthy. But
I heard Twitter was dead. It's not dead?
Yeah, I'm waiting for the service to melt down.
Okay.
Right, because there's a bunch of backend engineers like on bikes in the background keeping it up, right? No, that's not how it works.
Ligma and Johnson.
Yeah, I don't know. That whole I almost don't want to touch it, but
yeah, I don't think the world needs somebody else giving their Twitter 2.0 take right now. We'll save the audience from that.
We can talk about where we have core expertise, which is Web3 gaming and how great it's going on that front.
Let's dig into what's going on in the game industry. So yeah, I think our main segment today is going to be Xander covering earnings, but I wanted to do a little roundup. I'm normally the big Kool-Aid drinker, like Uber Bowl on all things Web3 gaming. So I'm going to kind of do the opposite today. I think we're in the mid gut punch of the depths of the bear market. So I wanted to do a little doom and gloom roundup, nice change of pace.
Great.
Cleanse the palate. So kind of two things I wanted to dig into. The first was just I think we're starting to see the first big rounds. I mean, there's clearly been layoffs across tech and gaming, but we're starting to have the first meaningful announcements from some of the larger companies in Web3 gaming. And so, the first is one that we missed a bit back, but Mythical Games early November did a 10% layoff of their staff. And they've raised over 270 million so far, and generally regarded as one of the larger, more respected Web3 gaming companies that actually have a product on market. I just wanted to cover this because they're a big name. I think even 10% in the scope of things isn't out of line from what we're seeing happening at the FANG companies.
Right.
A bigger one that just hit this week was Splinterlands, which is a game that we've covered. That when we had Robbie Young on, the CEO of Animoca, he was really high on this game and talked about it a bunch.
It's good. I played it. It's decent.
Yeah, I mean, all anecdotes are it's a pretty good game from people I've talked to and respect. But they laid off 45% of their staff. And
that's crazy.
Yeah, that's a game that's fairly well funded from all knowledge I have. Has a live product on market. Able to generate revenue. And this is probably the most drastic that we've seen so far. So I just kind of wanted to chat about this a little bit. I kind of have this theory that we're going to see the impact to the more mature games first. It's almost like when the product is still being built, I think there's a little more tolerance for investors to kind of put up with bleeding money a bit while there's kind of the promise of what will it be.
Right.
But as these products are coming to market, I think it's more clear of okay, your product's shipped. Now you have the burden of producing revenue, showing profitability. And so I think we're at the tip of the iceberg, but I do expect to see, and again, no one is bigger bull in the segment than me, but I think we're going to start seeing a large round of layoffs of the products as they come to market, when basically the big promises are not realized in one way or another. And sometimes it's just a case of the company growing too fast versus what they're able to sustain. I know, Xander, what's your take on it?
Yeah, I mean, do you know for the Splinterlands specifically, they pointed to market conditions. Is there any indication that they were holding assets in FTX and this is somehow tied to a run on them just losing assets, or is this just the fact that their team was too large for the amount of revenue that they're producing?
Yeah, no word of if they had any funds in FTX from the article that we've linked. yeah, the article does say the game distanced itself from the FTX saga, claiming it didn't have funds in at-risk
Okay.
exchanges or services, nor did it have debt or use leverage with funds. So I think this is just a case of, I know they've been building out multiple products in addition to their kind of core CCG game.
Mhm.
And I think they maybe just got ahead of their skis a bit with how they were funding development versus the returns they're actually seeing from their more mature product.
Right, and they're it's a good game, but they're very guilty of sort of the highly collateralized NFT system where they have their own tokens. They're using these cards sort of as assets, and it seemed a place that was rampant for speculation. I mean, it's literally trading cards, which are like maybe the best proxy for digital ownership. And so, I mean, I played the game; it was fun. I'm. It seems likely that this is a place where people who are doing a lot of rampant speculation are probably investing in holding assets, and so it seems that could be, as people flee the ecosystem, this could be someplace that's particularly hard hit.
Well,
Sure.
let me ask you something, Xander, because you've played a lot of CCGs. I do as well. Is it a product that you thought was accessible enough to a CCG player who had zero interest in Web3?
Yeah, so interestingly, so Splinterlands you can get on and play without basically setting up much of anything. You can just go onto the website, start playing right away. But the depth of being able to like start buying and trading cards, you have to go through the whole rigmarole of setting up a wallet, and it's like a Hive wallet, and you have to transfer money. So it has the whole. You can get started very easily, but then transferring over. I don't actually think I got my wallet or anything ever set up for Splinterlands. I think that was sort of the core issue. Is like,
Mhm.
I'm relatively deep into this ecosystem, but if I don't want to go through the headache of setting up all these infrastructure just to be able to play the game, you're going to have drop off. And that's actually why I dropped off, is because I didn't set up my wallet. And so I'm like a core user. I should be the
Yeah,
target
you're
market.
the ideal customer,
Right.
basically.
Exactly. And so like if I'm I'm reasonably well versed in this, not super well versed, but reasonably well versed. So if even I am trending, I think that is a really poor indicator of their ability to get their core audience to spend money in their game.
Yeah. Okay. To your point, let's next dig into some of the FTX impacts. So I think early on, what's been in the news a lot is obviously the direct FTX family of companies, and those financial institutions like BlockFi that were owned outright or had serious funds tied in FTX. I think we're starting to see the information about what's the impact to gaming, because FTX did have meaningful overlap with the gaming ecosystem as well. And two stories I wanted to call attention to. The first is Star Atlas, which is one of the kind of largest, most ambitious, most hyped Web3 games built on Solana. Solana itself has high ties to FTX and FBS, but they apparently lost 50% of their company runway in the
That's
FTX
wild.
collapse. Yeah, so they posted a letter to their community, which we'll link. And they basically said they've gone from years to months of runway, lost about 15 million of what they have in the bank. At least that's what they've publicly said. And that's pretty grim. This is going from one of the developers that was most ripe with cash to really struggling for how they're going to keep the lights on a few months from now. And it's a really promising game. It's an expensive game as far as development costs, but really going to be curious. So this is interesting. So what have they done to try to overcome this? They are having a Black Friday sale.
Okay.
And
Timing's good.
They're calling this plan the Road to Recovery. And good news, Xander, if you've wanted to get into the Star Atlas ecosystem, is ships, which are one of the main components, are part of this Black Friday sale, and they're 80% off.
Great.
So yeah, so if you want to get one of these really elite ships, they have a limited number of them. And normally they're $5 million each.
Oh my
so
God.
they're only $1 million each if you'd like to participate in the Black Friday sale.
I was waiting for a ridiculous number. Like I was bated breath, but that is so much more ridiculous and absurd than I could have possibly imagined. I don't even know what to say about that.
Yeah, I mean, obviously, Star Atlas, and I say this as someone who's I've admired the game from afar. I'm not deep in the ecosystem like I am in other games. So they have ships at all kinds of different price points. This is kind of like their most elite, most expensive ship. But I understand like their model is basically it's 80% off a large number of their ships, including these $5 million ships. Okay. And every week the price increases by 5% to kind of encourage people to purchase earlier. So that's their current plan to like recoup some of these funds and extend their roadmap. It's a novel approach. I mean, maybe the bar is really low. I'm just happy in the Web3 space when I see teams try to find ways to continue when they get punched in the guts,
Sure.
because I'm a big defender of the space, but one of the problems that we've had is basically, companies raise a lot of funds early on, they hit hard times, and they take the bag and they run, and that
Right.
creates a horrible reputation for the space. So, the pricing is silly. It's fun to joke about buying a Starship for $1 million when it's 80% off, but I am glad to see them actively pursuing a road to recovery, continuing to build the game despite the punch in the guts. Another
Well, I
game
have
I
a
wanted to
question
touch
though.
on,
Like,
yeah.
who is a target audience for this ship? Like, who? I think this is the problem with people who are when you're selling game assets before the game exists. Like, I mean, this is basically an investment. How can you look at this as anything other than an investment, right? And so, like, is there still an appetite for multi-million-dollar NFTs or million-dollar NFTs in the current market? And on top of that, it's like, was there an appetite before? I mean, I guess there was. You had people like Sandbox who were doing these big NFT buys. You had, YGG, all these big companies, but it just seems it seems so tone deaf in the current ecosystem to charge $1 million. I mean, for a ship. I'm
Yeah, I
just
mean,
curious who buys these,
to
and
your
like
point,
what is the
Xander,
point?
I mean, my bullish thesis is NFTs and Web3 for gaming Legos, like ways
Right.
to build game economies and game pieces. You don't sell those game pieces for $1 million. You sell those for $5, $1, $10.
Well, and maybe if there was a
When
game, you could justify it, right? Like, if someone sees $1 million of utility in a game, fine. But the thing that's just really strange to me is this is like before there's any. Is there a playable version of this game yet?
they have like a mini game or like a GameFi kind of staking game is my
Right. It's the
understanding, but
same. It's
yeah.
the same thing that exists in all these ecosystems that are melting.
So I was actually, it was just agreeing with you and reinforcing your point. So when a company is selling some sort of in-game item, Web3 or not, and let's just be generous and say a sub $100 price point,
Sure.
I think it's fair to position it as, this is a piece of the gaming ecosystem. When you're selling any Web3 asset for thousands of dollars to millions of dollars in gaming, I think it can only fairly positioned as like a financial investment. Like that
Right.
that cost point like is well out of the realm of anything that can be positioned as like, oh, this is your entry to like an aspect of gameplay. So yeah, I think we're going to see a lot of bearishness in the near term for at least that part of the Web3 gaming economy, those like whale-driven items, because it's not a time for speculators right now. But it doesn't reduce my bullishness on, just the ability to use the technology to build out games. So that's Star Atlas. One other story that I've been tracking that I'm curious to see how it pans out. There's another indie developer that was created by a couple of Magic the Gathering pros that I know and follow called Good Luck Games. And they built a Hearthstone style game that's pretty beloved. It's pretty niche, but pretty well loved in the CCG community called Storybook Brawl. Storybook Brawl was purchased outright by FTX in March. And Storybook Brawl last week announced that they're going to have to cancel their world championships due to impacts related to the FTX collapse. I'm just flagging this. It's obviously heartbreaking to have your company acquired coming from the indie game world and then see this is the people that acquired you. They haven't announced if there's any kind of financial impact, but there's a theme that we've seen from the companies that FTX acquires, which is that they strongly suggest / require them to hold their funds within FTX exchange.
Right.
So I'm just watching this one. There's been no announcement yet. I would be shocked if they didn't require a company that they wholly owned to keep their funds inside the exchange. So I'm just kind of nervous to see what happens. Like, there's good people on this team. They've got a well-loved product. It just sucks. It sucks to see just how wide-reaching the impacts are of just the negligence and intentional misuse and fraud of, just 3 or 4 people at the end of the day driving this, and impacts just across industries, ruining multiple companies, ruining people's lives. It's not going to be the last time we talk about it, but I did want to, open up a little bit and talk about specifically both the current and future impacts in the gaming segment.
Yeah, it's a bit of a bummer. I mean, are they one of the 11 companies, subsidiaries that filed for bankruptcy? Because I know a lot of FCX subsidiaries are filing for bankruptcy. Do you know if they were in that group?
They have not yet, to the best of my
Okay,
knowledge, but
interesting.
things change. I mean, the day we put a podcast out, by that night, it seems like the news is already old. So we'll
Right,
see. Just one to flag and keep an eye on.
makes sense. Cool. So we're trying something a little bit different this week for our main segment. This is a little bit of a beta project, but we're going to continue our trend of covering some tech earnings. And one of the things we want to do is just give some visuals to help sort of explain what we're looking at. And so we're going to do just that. I have a very short presentation, and mostly it's just high level numbers. But it just should give at least Warren some context for what I'm talking about. And then also for anyone who's following online on YouTube, they'll be able to see the same thing that we are as well.
And sorry to our podcast listeners, but we'll explain what's going on with the numbers
in intricate detail. So, we'd love to do a very deep dive on every company in the games industry, but the unfortunate reality is there's a lot, and we have to pick our battles. So we wanted to choose a couple. One that I think represents a pretty interesting cross section of all of console, mobile, and PC, and then two that are basically some of the ones we focus on and are most relevant to our games business, the business that we run here. So first thing I wanted to cover briefly was the Activision Blizzard's earnings, Q3 earnings. So just at a very, very high level, wanted to give these notes. So Activision's quarterly revenue was down 14% to 1.7 billion. And if you look at and we'll sort of talk about why, there are three operating segments in Activision Blizzard, and King. The Activision revenue is, during the Q3 segment, the Activision revenue was 480 million, a 25% decrease year over year, while Blizzard was 543 million with an 8% increase year over year, and King was the king with 692 million or a 6% increase year over year. The net income for the business overall was down 32% to 435 million. So this is a really, really interesting snapshot in time for Q3. This sort of, if you follow, there's a few interesting things to unpack here. I'd say number one, mobile remains the biggest, for the time being, we'll talk about this in a second, mobile remains the biggest part of the overall business. And the most interestingly, King and specifically Candy Crush continues to print money consistently, and that is something that has been the gift that keeps on giving for them. Blizzard is also increasing the amount of revenue they're driving, and what did Blizzard launch last quarter? It was Diablo Immortal. And so we're seeing that basically the portfolio that has been delivering for them this quarter and last quarter were their mobile quarter. And it's basically been consistently quarter over quarter, mobile has become a bigger and bigger segment of their business. Now, one thing to note, Call of Duty came out in the last week or 2 weeks ago, and did $1 billion in console sales, in PC and console sales. So while right now Activision Blizzard is the smallest segment of this overall, this is going to be very, very different story in Q4 when new console comes roaring back and has one of the most monster quarters we've seen in basically forever.
Xander, do you know how that compared to prior Call of Duty releases?
I believe it's the biggest of all time for Call of Duty. I don't know if they've quite yet become the biggest game watch of all time. I think Red Dead Redemption is still the winner of that. We should probably look that up. But yeah, I mean, absolutely monstrous. And they had a sort of a bad cycle last year, is my understanding of Call of Duty. And so they've significantly there's basically, the perception is there's a pent-up demand. But man, did these guys come roaring back from, I mean, Activision's always been the king, but and except for the last couple of quarters, and now we're seeing that, the flippening.
King is the king.
Well, King's been the king, but now, I mean, this is like, look at Q4, it's going to be just not even close. Like Activision is by far the biggest segment overall.
Yeah, I mean, shout out to King. I mean, I've always been impressed by them as operators. The more I get to know about the business and the people there, I definitely think it's rare to see a team that's still that savvy at performance marketing and that data driven at that scale. What we've generally seen is that the bigger companies get in the free-to-play segment, the more they start looking like brand advertising businesses. And so, yeah, definitely, I think it's a good opportunity for Activision Blizzard as an org to kind of look at the strategies for growth applied by its different divisions and like what works and what doesn't work in this kind of economic climate. So, if they're smart, they'll take the, and we've already seen hints from this. We know that Blizzard has really built out their performance marketing function, brought in some people with like really great reputations from the mobile free-to-play segment. And if they're smart, they'll take the playbooks learned at King and cross-pollinate and start using some more performance marketing in the PC segment as well. Not to get too ranty, but like I think there's one thing we've seen in the market is there's a huge opportunity to just bring more performance marketing to PC gaming, as it's just as a more of a legacy industry. The leaders, the technology around it, just there's less of a culture of performance marketing, more brand buying. And when everyone's been buying on brand and just awareness type buys, it creates a lot of open lanes to buy those subsets of inventory that are like laser targeted for your ideal users. So yeah, I think I'm cautiously optimistic, even though it's a bad quarter for Blizzard based on, like you said, Xander, the release they just had with Call of Duty, Diablo 4 next year. I am hyped for. I didn't go deep in Immortal, but I'm gonna probably check out from Life for a few weeks when Diablo 4 comes out. But yeah, I guess that's my take.
Yeah, so a couple of the questions. One of the thing that's interesting about King, they have basically the best brand. They have the luxury of having basically the most recognizable mobile brand out of any game ever. And so it's really interesting.
Say for all games, like if people play one game in the world today, it's Candy Crush.
Yeah. And so that, I mean, I think that's someplace where you have such incredible operating leverage when you're able to tap into that, historical knowledge of basically everyone. And when you see a Candy Crush ad, I don't really play Candy Crush anymore, but I see an ad, I'm like, oh, do I just click it? Do I just play it? So I think that there's something, I mean, if you think about what the Machine Zone playbook was 1,000 years ago, it's like, let's make our brand known by everyone. And they had to spend millions of dollars on Super Bowl ads to do that. And Candy Crush just has that because of their positioning, because they've been around for so long. So that's just lucky for them. One other thing I'll throw at you, and we can move on. Is Activision going to end up? Is Microsoft going to end up buying this? Any hot takes here?
Man, no idea. Yeah. I'm not going to place a random bet on that.
Yeah,
it's been a long time. I mean, how long has this been deal?
Their plan was for them to take a year or so to acquire it. My understanding is that now they've gone through like the first round of regulator approval. I guess the European regulators are taking a closer look at it now, and I guess we'll see. I don't have any particular hot takes here. It's not my area of expertise. Oh yeah, one other just interesting data point to throw out here. This just shows the distribution. This really just puts some numbers on the distribution by console, PC, and mobile when compared across their entire portfolio, not just by the segments. King, we obviously know skews towards mobile, and the other ones skew away from it. But if you look at it all together, console represents about 19% of their total revenue, PC represents about 20%, and mobile represents 52%. And so this is just across everything, but Activision Blizzard is a mobile game studio, at least this quarter. We'll see how that bakes out next quarter. Cool. Speaking of mobile game studios, we're going to talk about one of the most interesting in terms of their competitive positioning on a go-forward basis. Unity. So talk about Unity's Q3 earnings. A lot of interesting stuff going on with the Unity business right now. Their quarterly revenue was $332 million, an increase. Did I get that right? Yeah, increase of 13% year over year. But when we sort of dig into what's going on, something really interesting is happening. So their operate unit was 171 million, which was a 7% decrease. And remember, operate unit is the one that represents their ad network. It has a few other segments as well, but the main thing that this is representing is their ad network. Their ad network is decreasing in revenue year over year.
Which makes sense. That's the general trend that we saw across advertising this year.
Absolutely. It absolutely makes sense. But here's the thesis that I've been touting for Unity for quite some time, which is that their create business is the sleeping giant, which is going to allow them to continue to grow aggressively going forward. And what we see is that their create business did 128 million in revenue this quarter, which represents a 54% increase year over year. So basically, their revenue from the development tools has increased 50% year over year. And this is where I expect to see increased acceleration in revenue going forward. I don't know, increased acceleration, but a continued increase in revenue going forward. And we can talk about that in a second, but the sort of core reason for this is they are raising prices for some of their developers tools. And so as we move forward, I expect to see continued acceleration, or at least a continued increase in Unity's profitability from the developers tools. And here's the thing about developers tools. You can't pull it. They're so hard to pull out. You don't switch from Unity to Unreal Engine in the middle of a development. So you just don't, it just doesn't happen. And so,
and beyond that, you typically build your whole business around a specific set of developer tools.
That's correct. Yeah. And so, and not only that is like, as a generation of designers grew up on Adobe, and now it's really hard for them to switch, although I guess that is somewhat fraying now. A generation of developers grew up on Unity. And so like, this is a place where they have lock-in from like literally the people's education is locked in around Unity and how Unity works. And so, I mean, just the amount of leverage they're going to have from that as this unit of their business, and then being able to leverage the fact that there's lock-in on their developers platform into all the different operate and other business segments going forward, is a huge deal. And I guess the last piece of this is the ironSource and Unity deal closed. I believe the day that their earnings report came out, and the earnings are not, ironSource earnings are not in this earnings report. So it'll be really interested to see how the consolidating earnings look going forward. But the interesting piece is just that is exactly the playbook that I'm talking about. They will now be able to siphon people from the developers platform into the ironSource tool set. And, that is a flywheel that is going to be a gift that keeps on giving.
Yeah, absolutely. I think we've both expressed our bullishness on that Unity ironSource merger. Just that idea that Unity already has its hooks in such a massive percentage of all games, particularly in mobile. But they aren't a mediation provider. They've typically fallen short on both a biz dev and account management and sales, all the things that really drive advertising revenue, where ironSource is quite strong. But ironSource, it's pulling teeth to get you to integrate a third-party SDK or mediation provider. And so that problem almost disappears when these two companies become one.
Yeah.
And so leveraging, just echoing things you've said as well as Xander, leveraging what ironSource is great at with the market penetration that Unity has, super bullish for what these numbers are going to look like for the advertising business of Unity come like middle next year.
Okay, so that's the good news, and now we're going to dig into some of the bad news. And it's actually it's pretty fascinating. So Unity had a net loss of 234 million this quarter, or 74% of revenue. That was an increase from 128 million this time last year, which is 44% of revenue. So that's one of the largest operating losses and accelerated operating loss that we're seeing across any games business right now. And
what's driving that? Yeah.
Good question. Good thing I have this pretty slide that we put together for exactly this reason. So short answer is everything. So while revenue is up, their cost of revenue has also increased about, I have this written down, about 50% to 111 million. There's an increase in R&D costs about 39% to 248 million, a 12% increase in sales and marketing, and a 25% increase in general admin. So it's pretty staggering and kind of wild to see how much money these guys are losing now, especially in the way that the market is trending overall. This is basically the inverse trend that anyone would ever want to see. We're supposed to be moving towards profitability, not away from it. So I think one of the reasons why the ironSource acquisition is so important is because it's a cash flow positive business. It'll help offset the damage that we're seeing in these numbers. I'm actually fairly surprised that the market is giving Unity so much support. Basically, Unity's cost per share is about $20 after this earnings report, but it has since bounced back up to like 35-ish now, which is like 50 whatever percent increase, more than that, which is pretty staggering. And I think what that really demonstrates is the fact that the defensibility of the position that we talked about at the top is so clear over the long arc of history that like it's one of the few businesses where people are saying, actually, we see that you're having accelerating losses, but we trust that the business is going to be so competitively positioned going forward, it makes sense to continue to invest here. And just one other final note is they're also diluting the shares pretty aggressively as they give stock-based compensation to their employees. And so it's pretty wild to see this like sort of bifurcated narrative here, but how well Wall Street is saying, hey, listen, it's fine. Keep on, Unity's going to be fine in the long term. Any other questions or thought here, Warren?
I mean, just looking at the numbers that you pulled up, a lot of the costs going up, I mean, don't look wildly out of line with just sort of like the general cost of operating a business and how that's been affected over the last year. So it doesn't look like there's some huge unforced error. It just looks like it's gotten more expensive to operate this business. You know, salaries go up over time, cost of acquiring new talent. I think we're just seeing that when companies are operating on relatively tight margins, or hovering around that break-even point, you really feel an 10% increase in cost of operations around the board could end up doubling your net losses.
Right. And I mean, they just basically accelerated their cost in everywhere, which, I mean, I guess good for them. They can get away with it. Nobody else really can right now. Cool. Lastly, we're going to quickly touch on AppLovin. You might know them from being on the podcast last week. That is the only way that anyone has ever heard of AppLovin. Just joking. So AppLovin continues to operate incredibly well. I think, I've said it over and over again, but just the way they operate their business is so sophisticated from, a financial transaction perspective. Let's get to the numbers to see. So quarterly revenue was 713 million, a decrease of 2% year over year. Their games business, which represents the majority of the revenue, was 407 million, a 24% decrease, while their software platform business, which includes their ad platform, ad network, but as well as Adjust, Max, and all their other SaaS business products, showed a 59% increase year over year. They had a net income of 50-ish million for an 8% increase year over year. So this is pretty interesting. Basically, what you're seeing is they're optimizing down their games business, and we'll look at how they're doing that in a second as we look at the next slide. But the expansion of their software business is pretty radical, and it's obviously they've been able to conglomerate so many different pieces of the software business and cross-sell them and upsell them, that this is basically where they're going to realize a ton of value long term. I guess
Xander,
again,
did they clarify that the bulk of that growth came from the advertising platform?
On the software business side?
Yeah.
I don't believe they break out exactly where it's from, but I do know that my understanding is the majority of their revenue from the software business is from the ads network.
Yeah, that would be my assumption as well. Obviously, like, they have the Adjust acquisition, but I don't think that the Adjust, I would not predict growth of Adjust revenue in line with the macro trends we've seen in game development, new game launches over the last year, and just the scaling of games, which are all factors that would drive revenue from the Adjust segment.
Yeah, and
so I'm assuming it's mostly from the ads business.
Yeah, and we'll get into this into a second. Basically, it's the last couple notes. The margin from the games business is up 70% from a decrease in UA spend, and we'll look at it on the next slide. And then the software business is continuing to get its hooks into large customers, and we'll look at that in a couple slides.
That comment's interesting. So the margin is up for games because they're spending less on UA. So
right.
that almost has an implication that the spending for UA for the game segment was being done at a loss, and they've reduced that loss, maybe in the name of a grander aspirations.
Right. It was either that there was being done at a loss. I mean, so here's the numbers, right? So if we look at Q3 2021, the top line apps revenue was 534 million. And that basically peaked at Q4 2021 and then had a decrease down to where it is now, which is about 400 million. And what we see is that, this is adjusted EBITDA, but basically they're saying that in theory, these studios are operating at a positive margin. It's gone from 11% during that Q1 timeframe down to about 8% over Q1 and Q2, or sorry, Q4 and Q1, Q4 of last year and Q1 of this year, and now is landing around 17% as they decrease that spend. Yeah, so I mean, I guess the main thing to call out here is the fact that they are tightening their belt around user acquisition, and it's increasing the profitability of their games business. And as people who've been tightening belt around user acquisition during the same period, I mean, it just goes to show that they're pretty clever and sophisticated operators, and they're able to tighten the belt and drive increased profitability from this segment while decreasing spend. And they do decrease the revenue, but the thing that's so scary about this business, I use that word a lot with them, they don't like that, but it's the fact that their platform business is increasing and increasing growth at a pretty drastic rate. So here's a chart of their revenue per spec, which is software platform enterprise customer. Basically, this just means they're most valuable customers on the enterprise deals, and I believe it's something like more than 1 million a year. I can pull up the exact number. Basically, high value customers. And what you're seeing is that not only are the number of high value customers continuing to increase from 292 Q3 of 2001 to now almost double to 538, but the revenue per high value customer is increasing from 1.6 million to 1.9 million. Per year. And so this is really the thing that I think is most interesting to look at about this business. This is an incredibly high margin business, right? As opposed to a games business, which is, we just saw 17% margin. Their ability to continue to lever up the reliance of different games in their ecosystem to their software platform shows that even in the times when the games market is theoretically shrinking, in mobile games market specifically, they're able to lever up the reliance that people have on their platform in a really meaningful way to continue to drive profitability to their business. And so, that's what I say when, AppLovin are some of the most sophisticated operators. I mean, this is what I mean. Any thoughts here, Warren?
No, it's super interesting. Have a lot of thoughts. I mean, we've had an interesting relationship with AppLovin over the years. Like, from one side, I think we have tons of respect for the way they've been able to operate and grow their business. And Xander, correct me if I'm wrong, but I feel like this might be the first positive growth story we've had for the mobile segment. Seems like there's been a hit in almost every other company, unless I'm forgetting something.
Yeah, I think it's just that they obfuscate the ad network growth,
so it's hard to be certain, but
with the other platform fees and costs like Max, they're probably levering up. Even if they're losing money for the ad network, they're making up with Max and Adjust and all these other products.
Right, and I'm lumping together Max and the UA business. So I am going to assume, and Apple, at least correct me if I'm wrong, but I'm going to assume that that's the main growth driver. I mean, they've shown themselves to be like a powerful operator to make really, really interesting, controversial decisions in how they scale their business. Like the first ad network to acquire an MMP was a hugely controversial move. So I think from a business operator standpoint, a lot of respect. The frustrations we've had with AppLovin over the years have been more on sort of like the aggressiveness of the sales side of their business. And some, I won't get too specific, but historically they have a reputation for being one of the more aggressive on that side, which can sometimes have a negative effect, impact to customer relationship. But when you see a time of economic challenges, having like a really on point sales team and account management team can be the thing that pulls you through, makes you grow and survive and thrive when it's in the most challenging times. So I think it's a double-edged sword, the way they've built out that business. But ultimately, I mean, the results speak for themselves for the short term. And I think also, to their credit, we've seen the AppLovin team, I think, realize potentially some of the ways that they need to build longer term sustainable relationships with the industry, with their customers, and balancing that with making sure that they keep growing quarter over quarter. So it's a company that I've been critical of in the past, but I think that they are maturing as they grow in ways that I am impressed with, and I do like the evolution that I see from AppLovin.
Yeah, agreed. I think at a minimum, what we're seeing is they're getting better at understanding that they're the big guys in the room now and doing a better job of messaging around, we work with you, not against you. And I think that's something that was not always the tone that they took. Yeah. Anyway, that is our wrap for the big game earnings segment. Like we said, I'd love to do a lot more of that, but there's just a lot to cover. And so, if you like these segments, let us know, and we may do some more deep dives here.
Let's go do a good old-fashioned app of the week to cleanse the palate. Xander,
Great.
do you have an app of the week?
I do. Yeah. So my app this week was one that was brought up last week by Raphael, which is Marvel Snap. Marvel Snap is a mobile card game by the team at Second Dinner, who did Hearthstone, one of very famous and successful card game by Blizzard. And I got to say, this is one of the most played mobile games probably of the year at this point. Even though I've only been playing it for about a week. It's a simple to learn. Have you ever played Gwent, Warren?
I have not.
Okay, so Gwent is the Witcher card game. Anyway,
Right.
that created the basis of sort of the mechanics that for Marvel Snap. They've then skinned that with Marvel and done a pretty good job of basically giving you a very easy onboarding, but a long ramp in terms of being able to play the game and enjoy it over a period of time. So anyway, if you like CCGs, check it out. I've been enjoying it. You can check it out, Warren. Can I get you interested?
I think I'm sold. I think I've heard enough positive feedback from Marvel Snap over a period of weeks that like, yeah, I got to dig in. And it was the head of that game studio was the original game designer of Hearthstone, or the original head of that team.
Yeah, I think it was like
correct?
Team 5 or Team 6, the
Mhm.
Hearthstone team. He's now their
Yeah,
chief development officer or something. So he's like the
gotcha.
driving force behind it.
Cool. So I'm gonna echo you and stay more in like that CCG segment. I'm doing an old one this week. I have, as people can probably tell by my voice, which is almost completely shot, had an exhausting couple of weeks, and I wanted to retreat into the comforting arms of an old favorite. So after a long time of not playing it all, I opened up Magic Arena, and I've been digging back into Magic. So there's a bunch of new sets that I've played, and honestly, it kind of got on my radar because there's been a bunch of negative news around Magic as a brand lately.
Really?
Yeah, Hasbro had a horrible earnings quarter, a bunch of public downgrades from bankers. And a lot of it is there's been a lot of controversy of them essentially like going too far and milking their product. And I'll give a little context on this. This is kind of why I churned, at least temporarily, from Magic. It just became like too hard to keep up. Like it really increased the number of releases.
Right.
And all these like specialty, like direct print to customer products, they call like their Secret Lair series. Most of the products themselves are pretty cool. It's just like the sheer number. And then
Yeah.
they've gotten pretty wild with the pricing model. The most recent product they launched that got a lot of controversy was, they call it like the 30th anniversary. This isn't paper magic, but 30th anniversary series. And you basically get 4 packs of reprints, non-playable reprints of the original Magic set with different borders and different backs. So you're not actually allowed to use it in any sanctioned play. And it is $1,000
Are you
for
serious?
4 packs. I'm serious.
That is crazy.
Yeah, and this was for a lot of the community. This product hasn't released yet. It's going to release, I think, in the next few days. But for a lot of the community, this was like, I mean, Magic players are always saying they're quitting the game, but they never actually leave. But a lot of people are saying this is like the straw that breaks the camel's back. And it's also the first time that this kind of overprinting of product has gotten into more mainstream and financial news too.
Right.
And we're seeing, yeah, 2 things. I just wanted to flag like some of the issues with Magic as a product right now, but also reinforce like the game's still fun as hell. Like
Right.
coming in with a bunch of new sets I hadn't played, building new decks. It's just like, it's still to me like the greatest game ever made. And I just hope that as a brand they're able to preserve what's great about and what got them to this point with still adapting to the next era. And I'm the outlier in the Magic community. There's like, this game explicitly needs to convert to Web3
NFTs,
and
yeah.
NFTs. I know they're not going to do it for another 2 decades, but it just makes so much sense. It feels weird. That's the last thing I want. I've mostly been playing Web3 games this year, so to be playing a game, earning cards, a collectible based game where it's just like, wait, I can't actually do anything with this stuff. I can't trade it to
Right.
anyone. If I have extras of cards I'm using, I can't sell them. It just feels really weird. Like once you adapt to like Web3 game design. So that's my constructive feedback. I know they're not going to listen for another 2 decades, but I do think that would be a really interesting way for them to evolve their business.
Yeah, agreed. I actually went to upgrade to the new client on Magic last night, and it started to download, and then I Control deleted and killed it. I was like, never mind, I'm not gonna do it. I don't have the
Just
time
went
or
back
money.
to playing Snap.
I don't have the time or money for this. Yeah, anyway,
Awesome.
that's your CCG roundup corner. Cool. Well, thanks for listening, everyone who's still here. We didn't lose by our rambling. If you want to hear more of these types of content, let us know. We're going to be wrapping down the season. I think we have 1 more episode of the season, and we are getting a little experimental because in Q3 in season 5 we will be trying a bunch of different stuff, and so we wanted to try a couple different formats and see what works and what doesn't. If you have any feedback, please feel free to email us at apptalk@upptic.com or tweet at us Upptic on Twitter. Warren, do you want to take us out?
Yeah, I'll take us out. So as always, the podcast was brought to you by the good people here at Upptic. As we talked about, it's a very challenging time to try to launch and scale games, especially in a way that's economically sustainable for businesses. And that's really where our team focuses. So we're the team of experts that bring, we bring our people, we bring our technology that's all around profitable games growth in a very measurable, easy to understand way, handling all parts of that puzzle, from creative development to the data modeling to the operations of both paid media buying for user acquisition, and in the Web3 world, a lot of organics, partnerships driven marketing. So we love meeting and talking to teams building great games and exploring the ways that they can best optimize their business for profitable growth. And we're always happy to talk. So if you are either having challenges or aspirations of really scaling your game in 2023, reach out to us and let's talk. You can reach us at upptic.com. That's upptic.com.
Talk soon.